Let's talk about one of the biggest, most common myths in mutual fund investing. You know the one. You see a fund with a really low price tag and you think, hey, that's a bargain, right? Well, today we're going to get to the bottom of that. We're going to bust the NAV myth.
So, picture this. You're looking at two funds. One has an NAV of 20 rupees and the other is 200. I mean, your gut just screams to go for the cheaper one, doesn't it? It feels like you're getting more for your money. But is that really the smart move? Let's find out.
All right, so before we can bust this myth wide open, we've got to get on the same page about the main character here, NAV, or net asset value. What in the world is it anyway?
You know, it sounds super technical, but it's really not. At its core, the NAV is just the price of one single unit of a mutual fund. Think of the entire fund as a big pie, and it's sliced up into these little pieces called units. The NAV is simply the price tag on one of those pieces. Honestly, the best way to wrap your head around it is this. If you get how a stock has a price per share, well, you've pretty much got this down. It's the same exact concept, but instead of for one single company, it's for the whole basket of investments inside the fund.
So, where does this number come from? It's not like the fund manager just wakes up and picks a price. Nope. There's a formula, and it's calculated fresh every single day after the markets close. Let's peel back the curtain. It's basically a simple three-step recipe. Step 1, you add up the market value of everything the fund owns, all the stocks, bonds, the whole shebang. Step 2, you subtract all the costs, management fees and other expenses. And finally, step 3, you take that final number and divide it by the total number of units out there. And boom, that's your NAV for the day.
Okay, now that we have the basics down, let's get to the main event. It's time to tackle the big one, the great NAV myth.
And here it is. This is the big takeaway, folks. If you only remember one thing from our chat today, let it be this. A low NAV does not, I repeat, does not mean a fund is cheap. And a high NAV does not mean it's expensive. It's just a number.
Look, I get it. That can still feel a little up in the air, right? A bit abstract. So let's bring it right down to earth with a super simple analogy. And trust me, this one makes everything click.
I want you to imagine two delicious pizzas, hot and ready. And they're absolutely identical. Same size, same delicious toppings, same everything.
Okay, now here's the one tiny difference. We take pizza A and we cut it into 4 huge, generous slices. Then we take pizza B, its identical twin, and we cut that one into 8 smaller, more snackable slices. So you see, same pizza, just sliced up differently.
So here's the big question for you. Which pizza is cheaper? Which one is the better deal?
Come on, you know it's a trick question, right? Of course, neither one is cheaper. It's the exact same amount of pizza. The number of slices doesn't change the total value. And that, my friends, is precisely how NAV works. A fund with a low NAV is just a pizza that's been cut into a lot more smaller slices. Okay, so if the price per slice or the price per unit isn't what we should be looking at, then what is? Well, this is where we need to shift our thinking, away from price and towards what really matters, performance.
This is the real game changer right here. In mutual funds, what makes your money grow is the percentage growth. It's not about the starting NAV. I don't care if the NAV is 20 rupees or 200. What matters is the growth rate of the whole pizza, not the size of the slice.
Let's look at the numbers, because it makes it super clear. Say you put 10,000 rupees into Fund A with its low NAV. You get a whole bunch of units, right? Like lots of small pizza slices. You put the same 10,000 into Fund B with a high NAV, you get fewer, bigger slices. But look, if both funds grow by 10%, your 10,000 bucks becomes 11,000 in both cases. The outcome is exactly the same. The number of units you hold has zero impact on your actual profit.
So let's just agree to throw that old, busted way of thinking right out the window. It's time for a smarter approach, a much better checklist for picking funds.
So if we're not supposed to use NAV to compare funds, what should we be looking at instead? What are the things that actually matter when you're making a decision?
Here are the questions you should be asking. Number 1, how has this fund actually performed over the long haul? Say the last 3, 5, even 10 years. Number 2, are those returns steady or is it all over the place? Number 3, what's the risk here? And maybe the most important one, does what this fund is trying to do actually match up with your financial goals? That's what makes a good investment for you.
So let's put NAV back in its proper place. It has one and only one useful job for you as an investor. It lets you track the value of the investment you already own day by day. That's it.
It's a tracking tool, not a shopping tool.
So I'll leave you with this final thought. The next time you see a fund with a super low NAV and you feel that pull, that ooh, it's cheap feeling, just stop and ask yourself, am I just getting excited about buying more slices, or should I be focused on buying a better pizza?
And of course, we have to end with the important stuff. Remember, this is all for educational purposes. Mutual fund investments are absolutely subject to market risks, so you've got to be smart about it. Always read through the scheme documents carefully, and when in doubt, please talk to a qualified professional. Hope this helped you see NAV in a whole new light. Thanks for joining me.